So I think the biggest theme is fiscal dominance, which is basically that the size of U.S. fiscal deficits are impacting things more heavily than most other macroeconomic variables. So for example, it's more powerful currently than the Fed, currently more powerful than the slowdown we've seen in China and other parts of the world. And I think the big question to watch is whether that's going to continue throughout the whole year or if that gets overridden at some point. There's a number of economic indicators that have been very weak for the past year and a half. So falling PMIs, for example, purchasing managers indices, it's one of the more kind of more important rate of change indicators of the economy. That's been, in a downslope for quite a while. I believe it spent the most time below 50, which means contraction, without being official recession in history so far, which is unusual. We're also approaching kind of a long period of an inverted yield curve without a official declared recession. But on the other hand, we're seeing some of these indicators start to show signs of bottoming and turning up, reacceleration. Um, and I think what makes this cycle different from a lot of cycles that people are familiar with over even a long investing career, let's say 40 plus years, is that this is the first time we're kind of in an era of structural fiscal dominance.
In a recent analysis, financial expert Lyn Alden raises a red flag. Fiscal dominance is shaping a bleak outlook for the global economy, potentially ushering in a recession. Alden underscores the unparalleled impact of U.S. fiscal deficits, eclipsing conventional macroeconomic factors. With indicators such as declining PMIs and a deepening inverted yield curve, we're traversing unfamiliar terrain. As we grapple with this new economic reality, the pivotal question looms: can fiscal deficits catalyze a much-needed recovery in 2024?
Meaning that it's not bank lending and corporate bond issuance that is driving things. It's that the fiscal deficits are largely driving things, or at least that the relative weightings to those two things are tilted more heavily to the fiscal side. So if you look at most of the past 40 plus years, if you sum up annual net new bank loans combined with annual net new corporate bond issuance, that sum was bigger than annual fiscal deficit that year. Outside of like really sharp recessions, that was normally the case. But what we're in now is a more structural, long-lasting period where fiscal deficits are bigger on a year-over-year basis than the combination of bank lending and corporate bond issuance. And you really have to go back to like the 1940s to find a similar type of environment. So there's not a lot of people that are kind of have that in their backtesting models. Not a lot of people have that in their mental models or their economic models about how markets work. And it's really new territory because even when you do go back and compare it to the 40s, it's obviously a very different environment for many reasons. And so we're in kind of new macro territory here where we have some example past where this went before, but none of them are perfect analogs. And so I think that the main question to watch is whether or not these fiscal deficits are enough to reaccelerate nominally some of the things like PMIs, reaccelerate energy pricing. We're also seeing, potential Chinese reacceleration from a very low state. And so I think these are probably the biggest themes to watch in 2024.
After delving into the implications of U.S. fiscal dominance, Lyn Alden shifts her focus to China's economic landscape. Despite robust industrial output, China grapples with a housing bubble and regulatory crackdowns on tech giants like Alibaba and Tencent. Geopolitical tensions further compound investor unease, leading to foreign capital withdrawals from Chinese markets. Alden acknowledges China's strides in industries like automotive and aerospace, but cautions against overlooking demographic challenges and governance issues. While not foreseeing a dramatic collapse, Alden paints a picture of China entering a phase of moderate growth amid increasing centralization and reduced transparency under its current leadership.
So I think it's somewhat mixed. When you look at over the past 2 years or so, generally the output side, the industrial side, has been quite strong. So their exports are doing well. Particularly the car segment has kind of hockey sticked. So in most of their history, they were exporting car parts. They weren't really exporting a lot of finished cars. But in the past 3.5 years, that ramped up like a hockey stick. And they actually outpaced Japan as the biggest car exporter. And in the United States, we don't really see Chinese cars on the road, but if you go to Egypt, if you go to many other countries in the world, you'll see a lot of Chinese cars compared to what it looked like, 3, 5 years ago. And so they're kind of moving up the capital stack, you could say, or the complexity stack. So that they are doing really well in that segment. Obviously, where they're weak is that they've had a long-standing housing bubble, so very high valuations, along with a lot of debt tied to those high valuations for properties, which of course, a very dangerous combination. And the leadership there is aware of the issue, and they've been trying to kind of deflate that slowly. But of course, when they deflate that, they fail to meet their GDP targets. They start to get discontent. And then they
Mm.
combine that with going after the big tech stocks. So going after Alibaba, going after Tencent, going after a lot of the other kind of big, profitable businesses there. And then also, and that was all inside their control. And that's just kind of a kind of trying to doing a lot of things at once in a pretty authoritarian way. But then outside of their control, the whole, Russia-Ukraine war happened. And so if Americans held Russian stocks, that, even though the stock could be doing reasonably well, they just got zeroed out of their claims for those assets. And when a lot of investors look at China, they wonder what is the probability that happens to them in their investing horizon. So 3 years, 5 years, 10 years. What is the chance that they wake up and there's headlines in Taiwan, and then they wonder if any of their investments are still theirs or not. And so there's been a lot of foreign capital pulling out of China for a variety of reasons. So one of it is rule of law, just unclear around rule of law. They can wake up and decide we don't like this company, we don't like this sector, and so we can just kind of damage that sector. And then also just things that are outside of their control, like should there be geopolitical conflict heating up? And so they've had kind of all these things together. But we're starting to see is that as their equity market got very low, Chinese authorities started to come in and kind of support them. And also, as the real estate gets pretty weak, they are starting to kind of feel the pain and starting to kind of soften some of those policies. So I think there's a reasonable chance that it's kind of near bottom, which is relevant because even if you're not interested in investing in Chinese assets, um, it's such a large market for global macro, right? So part of the disinflationary impulse we've seen over the past, call it year and a half, is weak Chinese domestic demand. And should that start bottoming out and turning up, even if they don't reach their kind of prior growth rates, if they just kind of stop melting in the way that they have been, that could be an uptick for things like energy, things like copper, and just kind of overall reflationary forces. So I tend to be neither a super bull nor a super bear on China. I think their demographic issues are real. I think their debt problems are real. I think that kind of the lack of like rule of law and kind of capital market like priority is a real problem. But on the other hand, I do think that they are and probably will continue to move up the capital stack. So they get into cars, they're getting into airplanes, they're getting into, just overall kind of moving up that stack. They still have pretty low GDP per capita, pretty low energy consumption per capita, and I think those those metrics are probably going to be higher 10 years from now than they are now. So I'm kind of in the middle of the road on China, which is not the most satisfying answer. But when you combine that with some of the things we're seeing, for example, the U.S. fiscal situation, that adds certain macro forces. And kind of one other thing I'll add is that China is currently running almost the exact opposite playbook of the U.S. The U.S. has been trying to run tight monetary policy but very loose fiscal policy, meaning high real rates, but also very high fiscal deficits, whereas China has been running pretty tight deficits, but they've also been kind of running pretty loose monetary policy. And so that tends to have kind of the opposite effect. So, their output sector is still strong, but their consumption sector is weak. And that makes sense given the policy mix that they're doing. And I think it's important to realize, for investors to realize that always can switch, right? For example, they had their zero COVID policy for a long time. They were adamant about it. And then in 1 month, that all just kind of changed, right? There's enough pushback to it. And they all kind of were like, okay, we're going to pivot out of this. And you could see pivots out of China in terms of their policy. And I think we've seen kind of early signs of that as it relates to real estate and equity markets. But you could see that more in terms of overall fiscal monetary policy as well. Yeah, that's how I view it. And I also think, I mean, when you look at India as well, for example, India has better demographics, but even lower energy and
Right.
copper, kind of
Yes.
per capita. Places like India and Nigeria might be the like bigger marginal drivers, but I still think China overall is still probably going to be a positive driver. A lot of people compare it to Japan, which in some ways I think is a fairly valid comparison, right? So Japan went through this period where they were a big structural industrial output source, but then they peaked in terms of demographics. And I think just the one thing to keep in mind is that even though China is going through a similar situation, they're doing it at a lower economic level. And so there still might be more runway ahead on a per capita basis, which could push against some of their, declining kind of population statistics and overall issues there. So that's why
Mm,
I'm kind of in the middle of the road on China. I don't really see necessarily a big collapse of any sort, but I do think that they're obviously their fast growth periods behind them, and now they're in more of their muddling phase. And
mm,
obviously, part of it's going to come down to geopolitics or what their president decides to do, because in over the past decade, they have closed off a lot more. They were in this kind of multi-decade period of opening, and somewhat decentralizing. And in the past decade, they've been kind of re-centralizing and re-closing themselves off and reducing transparency and kind of, and that's a trend that's probably going to continue. And I don't think that's super healthy.
Today, we dove deep into the complex interplay of fiscal dominance and economic indicators, exploring Lyn Alden's insights into the US fiscal situation and its global implications. We then shifted our focus to China's economic landscape, dissecting its strengths, weaknesses, and the evolving policy dynamics. Remember, staying informed is key to navigating these uncertain times. If you found this analysis valuable, don't forget to subscribe to our channel, give this video a thumbs up, and share your thoughts in the comments below.